How do you cope with over a $200,000 loss in real estate? How does that affect you emotionally? We're going to dive into that in this episode, as well as how house hacking can be one of the most profitable, best ways to start. Don't just take my word for it. Take our guest Jordan Moorhead's word for it, and somebody will quote often in this show, and that is Warren Buffett. And you're going to learn why house hacking can be one of the best ways to get your start or to continue in real estate. This episode has been fun. It's been amazing. I'm so grateful and excited to have Jordan on. You guys are going to love it. Let's dive in and find out, is house hacking better? Is multifamily better? As we dive into the intricacies of getting started in real estate. Here's how I want to kick off, man. Jordan Moorhead right now, he runs a team. He's a realtor. He's an investor. I know you're an investor in some big projects. I know you got your start in, house hacking was a big way that you got your start. And I'm really excited to kind of share with our listeners just how you got started, how house hacking was as you put it, a big piece of your journey through this real estate investing kind of career that you've had. But what I really am curious about, man, I'd love for you to share with our listeners to kick off with is who were you before all of that? And how did you get your start into real estate?
Yeah, so I actually started investing in real estate when I was running a small personal training business. I had a couple trainers working for me. I had an admin, and I had read all the books. I had listened to all the podcasts, and I'd been thinking about it for a really long time before that too. It just made sense that you were going to buy something and somebody else was going to pay the bill. That was my only thought process, was I'm going to buy a property and somebody else is going to pay for it. I didn't know anything more than that until I started to learn. But I bought my first house hack while I was personal trainer, and actually kept buying real estate also when I was personal trainer for a little bit.
I think it's really interesting. So you're saying all you knew at that current point in time was I buy something and someone else pays the bill. And to be honest, isn't that if we look back at what real estate's done since that date, that would have been enough for us to become millionaires if we never, even if it never made a dime of cash flow. I've thought about that with so many of my properties, or it's just that's enough. But that's a super cool process. So how did you decide that house hacking was your first into this space?
I could tell you all the reasons, but the simplest reason was I didn't have any money. I had enough money after liquidating a majority of my Roth IRA to put a down payment on a $182,000 duplex. And that was 3.5% down. And I didn't pay any of the closing costs. The seller paid all the closing costs. So I got in by the skin of my teeth.
Where was that duplex, if you don't mind me asking? $182,000, where was that?
It was 2016 in Northeast Minneapolis. It had been listed in the low 200s, and they just had terrible marketing package. The tenants made it extremely hard to see the property, but we happened to go there while the tenants were asleep, and we lucked out. Seriously.
You walked into the property while the tenants were sleeping in the property?
So it was a duplex. It was a situation where the grandmother lived there with grown grandsons who were very aggressive, and they didn't want anybody to see the property because every tenant knows their rent's either going up or they're going to get asked to leave. So
that's crazy. That's a hack. Wait till your grandkids are asleep and then walk the property. So Jordan, tell us, what did you end up doing with that property? Tell us what did you end up doing with it? Did you rent it? So you obviously bought it, I'm assuming 3.5% down of $182,000, seller paid closing costs, and maybe just walk us on that deal full cycle. Do you still own it? Did you sell it? What happened with that one?
I did sell that property after a few years and 1031 into bigger properties or more properties, both. It had one unit upstairs, so it was an up-down duplex. It was in good shape. I rented that out right away. The duplex unit that we moved into was in very bad shape. I had to borrow the money to get carpet and paint done, $3,000 carpet and paint in the lower unit. And over the next 2 years, I saved up money to rehab the rest of it. I did a little bit of everything. I had one unit just rented long-term upstairs. I had a bedroom in my unit rented, and I made a porch into an Airbnb room. So I was doing a little bit of everything. And this was in Minneapolis, and that porch wasn't really well insulated. So I put a heater out there, And I had another heater out there, the little space heater, to keep it warm enough for people to be comfortable.
Holy cow, man, that's crazy. That reminds me of something David Green says a lot. He says, in order to get the highest cash flow returns, you have to have forced cash flow, he calls it, where you go into a property and you just see something a little different than a normal investor sees. So most people, when they see a porch, dude, they see a porch. You saw, I wonder how much I could rent this porch for. And you were scrappy. That's great. If you don't mind me asking, man, what did you end up selling that property for when you turned around and sold it, if you don't mind me asking?
Yep. Oh, absolutely. I think that's a great point to make. So I bought it for $182,000. I put about 15 grand into it for remodeling, and I got that all done really cheap because I was there myself, and I was really being, I was pinching pennies. I didn't have any pennies. I lucked out. A hailstorm got all of my siding replaced, and I sold that property for $327,000 about 2.5 years later.
Man, so here's what's crazy. So you bought it for 182, you put 15 in it. So you're at 197, my quick math. Let's round up. Let's say you're in it for 200.
200, yeah.
And the crazy thing is, just full circle to what you just shared at the beginning of this. You buy something, and even if you never earned a dime of quote unquote cash flow from that property, you made about 50 some grand a year just by the fact that you owned it, which is pretty powerful and pretty cool. What did you end up doing then? You said you 1031'd it, so you didn't pay any taxes on that money. You took $130,000 or more and to put it into another asset. What did you do with that money?
Bought 2 sixplexes. I also had to put a little bit more of my own money in to get that done, but I bought 2 sixplexes with that money and sold those early 2022. Didn't time the market, didn't do anything about that, but it just happened to be the time I wanted to get rid of them. I had bought another sixplex with the money that I saved living in that duplex. I had 3 sixplexes kind of right on the same street. The profit on those was $440.
Wow.
In 2022. And I had let's call it 75 of my money, my earned income in those properties.
Wow. Dude, congrats. That just shows the power of the expanding. I mean, honestly, it shows a little bit of the power of inflation too.
Yeah, absolutely.
A bunch of money with that, and asset values rose in accordance with that. So, man, let's kind of rewind for a second. Let's say there's a listener on here. They want to get their first or their second or maybe their third property, and they're considering doing this house hacking or co-living thing. What advice do you have for someone? How should they be thinking about getting into this space? Maybe specifically if it's their first or their second one.
So for the first, when I bought that property, I didn't think it was a very good deal. And everything I was looking at, I probably toured 60 or 70 properties with, I was not a realtor at the time, with my realtor, probably toured 60 or 70 properties. Nothing looked like it was going to work. This property didn't look like it was a very good deal. I said, okay, this will work. It's a base hit. But you have to get in the game. And I knew at some point I wanted to get in the game. I was looking for something that would cash flow after I moved out, and I would save money while living in it. And that was really my only criteria. And that was my only criteria forever when I house hacked. I did it 4 times. My fiance did 1. I just said, I want to be able to save money. I want to live for under $1,000 a month while I'm living in it. And I want it to cash flow when I leave it. And I just kept it simple.
Yeah, that's a really cool criteria. So you didn't have any big, hey, I want this cash on cash return. Hey, if I can live under $1,000 a month, you're taking what most people's largest expense is, housing, and you're reducing that significantly.
Well, and if you're cash flowing when you move out, let's say you've got a positive cash flow of $100 or $200 a month when you move out, your cash on cash return is going to be really good because you're putting such little money down. I've seen cash on cash returns on house hacks in the teens, 20s, 30%, just because it's such a low down payment.
Do you advise that people do the primary residence thing as often as they possibly can? Do you still pull that play and move to a new place? Are you done with that play, or what do you think of that play moving forward?
We did that 7 times. I don't know that we'll do it a lot more, but I always think that's the best way to go because of the debt. The debt is just the most amazing part about buying a primary residence. You get 30-year fixed rate debt at the lowest rates you're going to get it. And Sam, when you start buying real estate as investment property, those terms are unheard of. Those low rates, those fixed rates for 30 years, the best loans you're ever going to get.
Yeah.
They're really underrated.
Yeah, man, I think it was Warren Buffett. I was watching something he was saying recently. He said the 30-year mortgage is the best debt product on the entire planet. He's like, think about it. It's like shorting the US dollar.
Yeah.
So if the dollar loses value, you win because you're paying off a 30-year note with dollars that are now worth less than they were when you borrowed the money. So you're paying it off with less, more worthless dollars. He's like, but if it goes the other way and the dollar gets stronger, then you just refinance. He's like, you can't lose. He goes, oh my gosh. So that's really a really, really, really powerful thing. What would you say to someone who, they don't even have the money for the down payment of 5%? I know it's kind of a crazy like question, but how did you have that? Did you just have discipline to save that up? I know you said you cashed out your Roth IRA, I think you said, but maybe just talk a little bit about maybe some of the habits that it takes to even get in the game. You mentioned get in the game, and then you also mentioned something I want you to explain to listeners. You said it's a base hit, and I was hoping you could maybe just explain what a base hit is and kind of how your brain processes base hit versus a home run, and how important it is to get in the game with that.
Yeah, no. So I'll talk about the base hit versus a home run first, and then we'll go into more of the discipline and what didn't work for me and what has worked for me as far as managing my finances. I think home runs are impossible to find, and to me, any deal I've done that's been a home run it's never appeared as a home run. It's only after the fact that I've gotten into it. So I'm always just looking for base hits. How can I find a property that's in a location I like that's going to meet my minimum acceptable returns? And that's all I look for, because I know if I do those over and over, back to Warren Buffett, compounding interest is one of the most magical things in this world. If you do base hits over and over and over and you don't lose money, and we could talk about losing money here a little bit later in the show, but if you don't lose money, you will be enormously wealthy over a long period of time. But it's just continuously doing something over and over and hitting those base hits. And I think the base hit is so important because that's generally a safer investment. That when people are looking at base hits, they're saying, okay, this is a base hit. It's probably not something that's super risky. And generally, when you're looking at a home run, there's a lot of risk associated with that. It's, cap rates are just that way. A higher cap rate is generally a higher risk. So higher risk, higher return. But if you can get a base hit, let's call it a 8% cash on cash return deal in a residential property, it's probably in a decent area. It's probably in a decent metro that's up and coming or is growing at least. And it's going to be a good deal long term. To the discipline to save. So I tell all the agents on my team to have a system for managing your money. I've always been self-employed almost my entire adult life. And when you get good at making money, it doesn't mean you're going to have money. So you have to have some sort of system of setting aside 10, 20, 30, 50%, whatever you want to set your goal for, and just set that aside immediately. I use a really simple version of Profit First. My fiance set everything up, all the different accounts and that kind of stuff, but I just take a large chunk of whatever I make and I set it aside for investing.
Dude, that's awesome. Yeah, and if anybody hasn't heard of the book, there's a whole program out there called Profit First. It's how to set up your accounts, right? How to make sure that you're paying yourself first, you're paying the important things first, and making sure there's something left over. Versus what a lot of people do is like, well, especially in your case, as they run businesses, like, oh, I'm putting all my money back in my business. Like, no, that's not going to get you long-term wealthy, right?
I just take 50% of everything I make and put that aside.
Wow.
And with real estate, we have great tax treatment. So usually I don't have to put too much of that towards taxes at the end of the year. And I can just keep investing it over and over.
And it's crazy. I wish people understood more the power of what you just said. You're able to take 50% of your income. You're able to put it aside. First of all, congratulations. That's a huge number. I think anybody on this call listening would be like, holy cow, I think about 50%. But that's a great goal to aspire to, man. Like, I think that's a vision for anybody listening to this. Like, look, there's a world and there are people out there, Jordan being one of them, who are putting 50% of what they make aside. How do you have to adjust your lifestyle? I think that's a question I would want the audience to take away. What would you have to do to get to a place where you're living on 50% of what you make? And how fast would your investments start to spiral if that's what you could do? And I just wish people took that really seriously, man, because I think that's valuable. I mean, people I think aren't willing to maybe make the sacrifices that would take. Like, hey, you might have to house hack. You might have to downsize your house. Why do you think people don't get to a level? Like, do you think it's truly impossible for some people to save 50% of their income? Or do you think it's just like, no, they're just not willing to make the sacrifices? And if so, what would the sacrifices that you would maybe encourage someone on your team to make to get to a 50% save ratio so they can invest?
Yeah. So number one, having consumer debt, especially with the interest rates on a lot of consumer debt, will just kill you every time. You don't have to be a Dave Ramsey follower. You don't have to do everything he says, but consumer debt will just kill you. Just don't have any consumer debt. Try to pay off your credit cards in full every month. Drive a paid off car. It drives 95% as good as the brand new car. You don't need a new car. And then house hacking really did it for me. So it was having those simple rules. I'm not going to carry a balance on a credit card. I'm not going to have a car payment. I drove, everybody thinks a realtor needs to have a really fancy car. I think that's just a completely made up thing in everybody's head. I drove an old paid off car for a long time, and I have a newer paid off car now, but just not having consumer debt makes all the difference. And then your housing expense is going to be most people's largest expense. And when you're house hacking, that goes way down too.
Yeah, man, I feel like most people's response when they hear you say 50% of your income is going to be like, there's no way I could do that. That's going to be their initial response. And I guess I'm just asking the audience to kind of set that aside, set that little thought aside for a second and ask a different question. Ask, Jordan's doing it. Other people are doing it. What would I have to do to save 50% of my income? Let's get super creative. I mean, it could be as simple as, like, my wife and I are thinking about it right now. Like, how can we buy a house? Because we're in the process of moving right now. We want to move from Charlotte to Asheville, North Carolina. How can we buy a house that has a guest house? Mm-hmm. And we live for free? Like, we're house hacking, right? Even like, that's not house hacking, but that's like property hacking.
I would call that house. I think house hacking is just renting out any space that you're not using on the property. So whether it's an ADU or a duplex unit or bedrooms in a single family, it's all money that's helping you pay your mortgage.
Yeah, I like that a lot.
I had a client that rented out a garage in a duplex he had. He didn't need the garage. He rented out the garage.
Dude, what do you have that you're not using, and how can it produce income? That's the goal.
It could be a car. It could be your camper. It's whatever. People do Turo, and they make extra money off their car when they're not using it. If you work from home and you barely use your car, just Turo your car. Pay some of those expenses. And I think back to what you were saying, Sam, of what do you have to do to make that happen? You can get creative, start renting stuff out, start paying down consumer debt aggressively, get into your first house hack. Do that as often as you can, because eventually you will reach a point where you're not willing to keep moving, or your fiance or spouse, whatever, is not willing to keep moving. And you're going to have to settle down at some point in time. For most people, some people can keep pulling it off. Maybe you find a house with an ADU in a nice area like you're talking about, Sam, but most people are going to hit that limit after a couple. But some people take so long to pull the trigger on the first one, they hit that limit a year or two into the first one. They say, well, I know I did the duplex thing once, and that's great. More power to everybody that's able to do that one time. But if you can do it 2, 3, 4 times, the results are so much bigger.
What I'm hearing you say, man, is it's a call to action for anybody listening to this to start now, to do it now, to not wait. Yeah, best time to get in real estate, 20 years ago or 15 years ago. Second best time, right now.
And then keep doing it as quickly as you can. There is some urgency to that. Mm-hmm. I wish I realized that more. We delayed, not a long time, but a couple months sometimes. We probably could have gotten 1 or 2 more in before we're into our current house here. But there's urgency to it. You need to move with speed, because time is is your friend when you're buying real estate.
Yeah, that's beautiful, man. I know you said something a little bit ago about losing money. I want to kind of segue into like, I think Warren Buffett's, we brought Warren Buffett several times into this conversation already, but like, I think he says, first rule of investing is do not lose money. And second rule of investing is see rule number 1. Explain to us from your perspective, how important and how do you think about not losing money? Like, how does your brain wrap around that?
It's all about risk for me now. And I guess, Warren Buffett preaches it because of compounding interest. So if you lose 50% of an investment, it takes so much longer. You have to make 100% gain to get back to just break even. And a friend of ours, Hans Box, talks about that a lot in his presentations. Is if you lose 50%, you have to make 100% gain to get back there off that same money. But if you lose 100% of your investment, it's so hard to get back there, and then you're just at break even, and you can't compound from there. So if you could have made 8 or 10% annual returns on that money in a safer investment rather than a risky one that might have made you 20%, you're way ahead of the game. So I think of not losing money. There's a couple things you can't control with real estate investments. There's a lot you can control, but what you can't control is the government, and you can't control the market. So if you buy in a market or a state that is not landlord friendly, you're not going to change that on your own. If you buy in a market that's shrinking, you can't do anything about that. You're not going to change that on your own. So I look at those things as my first indicators. Am I even interested in this deal? Is it an area that's growing? Is it a state that's landlord friendly? After that, what I've learned from having some big losses here recently is I don't need to invest in anything fancy that I don't fully understand. So back to that, the house hack turned into a big gain, $440,000 from selling those sixplexes. I lost about half of that in a passive investment that I did not fully understand, with somebody that I thought was trustworthy. And well, yeah, what are you going to do? It's done. I've learned a lot of lessons from it. I will not do that again. And maybe it wasn't this person's fault, but it was something that was really risky. It wasn't fixed rate debt. So I think the debt is one of the riskier places you can get into things. Not having debt that's fixed for a certain period of time or a reasonable period of time. And again, kind of being at the whims of the market and the whims of the government really took down this new construction project that lost a lot of money for a lot of people.
Tell me about some of the lessons that you learned along the way. Like, were there, so I kind of a couple of questions wrapped into one, and you can take this wherever you want to go. But I think everybody listening to this would love to avoid losses. So I think we got a captive audience here. I want to avoid losing a couple $100,000 in an investment. So were there red flags at the beginning that maybe now you see, but you didn't see at the beginning? And if so, what were those? I think you might have, maybe debt was one of those red flags or things like that. So I'd love for you to go into that and just like, how you've processed this mentally, and like taken lessons. I know you, man, we're in a mastermind together. We're in a millionaire mastermind together. And so it's, I know you're the type of guy that you're going to take a loss and you're going to make sure that loss you learn from it, right? So I'd be curious how you're processing some of those. And then honestly, a little bit more of a personal question. And, it's like, how did that affect you emotionally? And how did you deal with that too? I'm really curious about. I know for me, I've experienced some losses, not even financial losses, man, just some stuff with family and different things. And it's so weird to me how emotional losses, whatever those are, can affect you in a big way. And I'm just curious how it kind of hit you and how you either worked around that or you're working through it or whatever. So again, I know that's a lot, but just kind of what were the red flags, if there were any? What are some of the lessons you're taking away? And then was there any emotional processing that you've had to do in this project that you invested in that just went south?
I want to say the red flag. So there wasn't necessarily any red flags specifically with the project or with the sponsor. Take that back. Everybody says, I want to invest with somebody that has gone through a downturn. I think the lesson I learned from this, and this is not to say that what person is good or bad, but I want to see how a sponsor handled everything through the downturn that they went through. Not just that you went through a downturn, how'd you handle it? And I didn't look into that. So I don't have any context on how this person handled. They were active during the last downturn, and I don't know how they handled things. I just know that they were active and they lost a lot of money in the downturn there. I should have asked more questions at that point in time. Lessons I learned from the deal. This was, I invested this money early 2022 when things were really hard, and I thought I was just pushing the easy button. It's the too good to be true really rings true with me there. I should have never taken a path that was that easy. If it's that easy and all you have to do is press the easy button and it happens, I didn't do near enough due diligence. That was all on me. I just thought I'm going to give this person money. I know this person, that I have associated groups with this person. I think they're a trustworthy guy. I should have done much, much more due diligence, and I should have bet on myself and not on somebody else. I know how to run real estate deals. I've done it quite a lot. I was doing quite a lot of successful real estate deals during that time. So I should have bet on myself. I should have done more due diligence on this other person, and I would have looked and saw how did they handle the last downturn.
That's great wisdom, man. Keep going. That's brilliant.
Yeah, I'm not saying I won't ever do any more passive investing, but that will be a very small portion of my investing, and I will bet on myself much more often than I will bet on other people. I got into a space in about this year period of time where deals were really hard to find, and I didn't put in the work and the effort to find the deals. I just said I'm going to invest with other people, and none of my losses have been my own losses from my own deals. Any of my losses have been from investing with other people.
Did this individual have money of his own in the deal?
Yeah. Yep. All the normal check boxes you look for were checked on this deal. Yeah. They've got experience, they've got money in the deal, all these things.
Yeah, man. I remember looking, because I looked at the exact same deal that you are talking about. I know what deal it is. We're gonna keep it private for the purpose of this conversation. But I remember looking at the deal, and I do remember that thought coming to my head of like, wow, like this does seem like it seems like a million things have to go right for this pro forma to pop off, like they're saying the pro forma is going to pop off. And maybe just to bring this around to like house hacking and co-living, that's one of the reasons I like co-living, is because a bunch of pardon my language, but a bunch of shit in co-living could go wrong and you can still not lose money. And the reason for that is the two big reasons you've already mentioned. One is like you get fixed rate debt a lot of times. Now, you can get variable debt on a single family home, but most of the time you're going to get a 30-year fixed mortgage, whether that's a investor DSCR loan or a primary loan or a second home loan or whatever. So you get fixed debt. So that's pretty fixed. And then if you have a 6-bedroom house or a 7-bedroom house or an 8-bedroom house, half of those people could be gone. You could be at 50% occupancy and still be covering your nut, still be covering your basic expenses. And so something I think about is like vacancy protection. Of like, okay, I might not be making money, but I've got time. It buys me time to kind of figure it out, versus where if I have one tenant, then like they're gone, and I'm not making any money, and that thing is costing me money every month. And so that's a really cool thing, I think, to this that makes me kind of like that. But that's a little bit of a different. I segued a little bit there, but I just wanted to kind of throw that like thing in for co-living. It's one of the reasons I'm so sold on it in this market.
And you have easy exit strategies. It's a single family property, which there's a scarcity of, and they're very easy to sell. So if you're buying a property in an area that is popular, you're having no problem selling that if things just don't work out. Or you could rent it out as a long-term rental or a medium-term rental or a short-term rental. There's many exit strategies there, where with some of these commercial projects, and they're on these terms, these 3-5 year debt terms, everything, like you said, Sam, everything has to go right for everything to work out, or it's either good or bad. There's not like so much in between.
Any other lessons that you feel like you've taken away from that experience that would be valuable for people to hear?
Yeah, absolutely. And I'm so glad that it happened to me too. So I think people probably hearing it and saying, why would anybody ever wish that happened? And I don't wish this happens for anybody, and I hope it never happens to me again. But I think I had a lot of my self-worth tied up in my net worth. And after I lost this money in this investment, I was able to really assess and I do a lot of reading. I'm somewhat of a spiritual person too. I was able to really look at things from a bird's eye view and say, my net worth is not tied to my self-worth. And money doesn't really matter. That doesn't mean that I'm not motivated to continue to grow and do better. But nothing changed when I lost that money. I was upset, but I'm okay, And I think that was a great lesson to learn. It's a hard lesson to learn. It was a lot of money to lose. And I think the more troubling thing for me was half of a gain I had from a large sale that came from just a really small amount of money that I had to cash out a Roth IRA to make happen. And I just grew it and grew it and grew it, and then half of it's gone. So.
Well, man, I really wish that lesson could apply to anybody else listening. I think you're probably the only one that ties your net worth to your self worth. I'm being sarcastic, of course, dude. I'm just pulling your leg because that's yeah. Go for it.
Well, and I started to look at things, and I'm saying I'm putting importance to some made up thing. Money is a made up thing that we tie to some other made up thing. So the value is not tied to anything real. And people put so much importance on this money, and it is important, and you need to work hard, and you need to be smart with your money. I'm not saying I'm not a good steward of my money, but I'm not emotionally involved with it as much anymore after this big loss. And I think that's a good gift.
Dude, that is a huge gift. I'm so glad you shared that with us. That kind of answers my question about how you processed it emotionally. It sounds like it was difficult, but it taught you a valuable lesson to kind of decouple like who you are as a person, your intrinsic worth and who you are from this thing. And dude, it's funny you say the words, this made up thing, because I remember the day I was studying like the Federal Reserve, and I was studying how they make up money. And I was like, holy shit, like they literally print this stuff. And I'm all emotional over something that they literally comes out of, that someone strokes on a keyboard and makes it up. Like,
yeah, completely made up.
Wow.
Yeah, we've placed value on something that has no redeemable value anymore. It hasn't for a long time. But it's completely made up. It's like your social media follower count. A lot of people place a lot of value on that. You don't own it. It doesn't matter. It's just completely made up. We've decided what gives money value is our belief that money has value, and it does. Try going to the restaurant tonight and getting dinner and saying, "Well, here, I believe in you. I'm not going to pay you any of this actual money."
And should that belief disappear, though, I think we would all be in a world of hurt. But yeah, you're right. Right now, it runs on it. Thank you for sharing that lesson with us. I think that's something that I needed to hear right now as I strive. I'm a big striver, trying to want to have a future for my family and my kids and my kids' kids, and pass on something I'm really proud of. But at the end of the day, stepping away from it. You mentioned bird's eye view, to recognize we're blessed to be where we are. That's just a good decoupling, man. I really appreciate that. But I want to segue from that, unless there's something else you want to add to that, to just multifamily is still kind of, a little bit of all the rage. And I want your opinion on multifamily investing. Grant Cardone's still preaching it from the rooftops like it's the thing. And it may be. I'm just curious what your thoughts are on commercial real estate. I know we were talking off mic that, commercial real estate, every headline I see right now is, banks are going to take a loss on commercial real estate. Office spaces are not filling back up, all of that. And so obviously this deal, just to give a little context, this deal that you lost some money in was a commercial real estate type of a deal. We've talked a little bit about the debt and how debt on commercial real estate adjusts. A lot of times it's on these 3 or 5 or 7 year kind of adjustments where the interest rates adjust. I have a friend who owns a bank. He went from a 3.2 interest rate to an 8.5 interest rate because his 3 years was up. It's like on a $1.5 million bank, $1.5 million bank that he rents out. He doesn't own the bank. He just rents out the bank building. And it was like, holy cow, like that's crazy. Try taking $1.5 million and 3.5% interest to 8.5%. That makes a huge difference on your debt payment. So talk to us a little bit about like, how do you perceive interest rates and commercial real estate, specifically multifamily? Again, I'll let you take that any way you want to go. But I'm curious your take on that.
So yeah, it's interesting you ask. And I own commercial real estate. I own a mobile home park with some partners. We're looking to buy more mobile home parks. So I think it's a great place to be if you buy it right. Again, you have to buy it with the right debt, and you have to buy it at the right basis, or you can get hurt if things change. And what I mean by that is when the debt rate went way up, cap rates went up, and that's how commercial real estate is valued. So net operating income divided by the cap rate is how you come up with the value. And when the net operating income stayed stagnant and the cap rate went way up, the real estate lost a tremendous amount of value. And I'm not going to get into that too much, so I don't want to take up too much time. But if people were paying these 5 and 6 caps for mobile home parks, for instance, and now they're selling at 8 caps, they're worth tremendously less. And where that can hurt you with debt is when you're trying to refinance a debt. Let's say you have $1 million loan on this property and it was worth $1.3 million, and it adjusts, and now the whole property is only worth $900,000. Just to refinance, you might have to bring all this money to the deal. A lot of these commercial guys right now, multifamily, are saying, hey, the loan term is up. I had this very short-term loan to get this deal done, and now that's up, and I'd have to raise millions of dollars to refinance. So they're just letting it go back to the bank because they're not able to get that money. Like anything, I think it can be great, but I think we're going to really find out who is a professional and is very skilled, understands debt cycles, and I think we're going to see a lot of people get hurt. So if I were looking to get into multifamily right now, which I don't like that space so much, I think it's too crowded, I would wait for a couple months and see what happens here, because I know a lot of groups that if rates don't go down by the end of the year, they're going to be in trouble. I think it was portrayed as being a really easy way to make a lot of money, and people didn't take the time to get really good at it. I know so many people that bought a duplex and bought a fourplex, and then they bought a 40 unit. And you can do that, but I don't think I'd want to invest my money with that person because they don't really understand the game. They just jumped in.
Yeah, man, I think it's interesting. How would you recommend that people, and I know a lot of people in the commercial real estate space. Great example I just gave, my friend who owns a bank or someone who owns multifamily. I think it's going to be a very interesting space. I think you're right. I think if rates like come down in the next 6 to 12 months, then probably fine. But if they stay high, or heck, if they even go higher, man, like that could be the detriment of this space in a big way. And I'm curious, maybe the government will come in and backstop it. I don't know. But what I would ask you is, how can people, let's assume rates stay the same or even go higher. How can people do anything to protect an investment they've made in this space, or that they're considering making in this space? Can they do anything right now to kind of anticipate versus just react, I guess is what I'm asking.
I would say if I'm considering making an investment in commercial real estate right now, I'm getting fixed rate debt for as long as I can. And what I did, we just bought this mobile home park in November. I negotiated with the banker that we could refinance if rates went down. So we have a 5-year term on the debt, which doesn't sound like a long time, but I think is fine right now because rates are pretty dang high. If they're this high in 5 years, we're going to have a lot more problems because so many sectors cannot operate with rates this high for that long. So I was comfortable with that, but we can refinance if that goes down without any sort of prepayment penalty. So I would try to get as long of a fixed rate if I can. If you're in a deal right now and you're not in control of the deal, you're kind of hoping and praying. Communicate with the sponsor as often as you can. See what can be done. If I'm running my own deal right now, it's on some sort of variable rate debt, I would be communicating with the lender as often as possible. I would doing everything I could to keep that property fully occupied, the rents as high as possible. I'm invested in some passive deals that I'm leaning on them very hard to do these same things.
So communicate with the sponsor, check in on the operations of that business, because if that thing's 100% or 98% occupied, like, hey, you have a better chance of surviving. So how are the operations of it? And I do know a couple of multifamily deals recently that have gone south, not even from a debt standpoint, big multifamily, just because the operations, they had some pressure from the debt and the operations just sucked.
Yeah, they just gave up. I've seen a lot of people give up, and it's really sad because they raise millions of dollars from other people, millions of dollars of hard-earned money from other people, and they just kind of throw in the towel and things get tough. And that's going to give us a really good idea of who you want to do business with in the next cycle. But unfortunately, I think a lot of people, myself included, are going to lose a lot of money.
Yeah, man, that's crazy. Wow.
Terrible.
Well, man, thank you so much for sharing kind of your thoughts on this. I hope people are just, recognizing, obviously, this is like for some of the reasons that we're talking about, this is why I'm all in on house hacking. If people are starting, I know that's a big part of your strategy. It's why I'm all in on co-living. I mean, it just feels really good to have a bunch of homes that I've bought in the last 5 to 7 years, all on interest rates that are anywhere from between 3 and 6%, and they don't change for 20 more years. Like, that feels good. I feel lucky, right? And there's a whole nother challenge of like still trying to get equity from those properties. And in some ways, interest rates don't matter if the property is cash flowing enough. So I talk about all the time, like, hey, you can pay 9%, 10% interest rate as long as that thing is cash flowing. So even if interest rates are higher, it's really a matter of how good, like you're saying, like how good does the deal actually look? Are you doing your due diligence on the deal? Which is a lot of co-living deals can look that good, even at 9% or even at 10% interest rate, which is kind of crazy to talk about. But man, I know one of the things that you do is you help people specifically in the Austin area, like either get into a house hack or obviously just buy real estate in general. Would you talk a little bit about kind of the team you've built, how you help people? And I think what's so cool, and I'll just say this because I hope you reiterate it, but like you're an investor. You're an investor who's actually had some wins. You're an investor who's had some losses. And now you're helping people get into the real estate game. Man, that's the person I would want to help me get into the real estate game or buy my house, is someone who understands the cycle, someone who's been there, someone who's actually done it, not just someone who's just talked theory for 5, 10, 15, 20 years. And so tell us a little bit about what you do, how your team operates, and how you support people in kind of getting into the space.
Absolutely. So we mostly work with house hackers and newer investors here in the Austin area. Just because that's how I got into it. I don't hire agents that aren't investors themselves because it's just hard to teach that mindset. Like you just mentioned, Sam, you can study theory all you want, but until you get in the game, it's just hard to learn. So there's only so much, and for anybody listening, there's only so much learning you can do listening to podcasts. You have to get out and do it at some point in time. So my team, we've got an amazing admin staff here. We've got some amazing investor agents on our team, and we help people get into house hacks in Austin here and co-living. We actually do quite a bit of co-living with people too. So strategies that can work in Austin right now are house hacking with some sort of medium-term rental or short-term rental component, or co-living. And then those can work outside of house hacking too. But the long-term rental, or buying a duplex, living in half and renting the half, or renting both long-term rental, has not worked for a long time, since about 2018 on a big scale. And you have to get creative. And a lot of people say, well, I just want to do long-term rentals. Why would you do something it's not going to work? So it's going to be impossible to make it work. But why would you do something that's suboptimal, where you could optimize it? You could utilize co-living or medium-term rental or short-term rental and cash flow really, really well. It's just silly to do long-term rentals now.
How do you define the difference between co-living and house hacking? I know I kind of define it for people on the show a lot of time, but I'm curious kind of like how you see the difference in those two terms.
Co-living, generally you don't, well, I would, in my definition is co-living, you don't live in the property. You found a 4-bedroom house and you made it a 6-bedroom house. You rent out all 6 bedrooms. House hacking, you're either buying a single family, a duplex, fourplex, whatever it is, and you're renting out any space that you're not using. So if it's a house, it's the extra bedrooms. If it's a duplex, it's the extra unit. It could be also the extra bedroom. I highly recommend that for single people or people who are creative. Rent out your unit, part of your unit too, and you can make money to live in your own house hack.
Well, man, if somebody wants to get in touch with you, your team, what's the best way to do that? How do they get in touch with you and how do they work with you?
Either you give me a phone call or shoot me a message on Instagram. I'm at Jordan_Moorhead on Instagram. And my phone number is 512-888-9122. You can call or text at any time. But yeah, I think if I were to say anything, it was get in the game. Don't overanalyze deals, but do base hits. Don't look for that home run, and just do as many base hits as you can rack up, and the time value of doing real estate over and over and over will compound, and you'll be a multimillionaire before you know it.
Boom. Jordan, thank you so much for sharing your wisdom, man. Thanks for diving into some deep topics. Thank you so much for sharing just kind of about how you process the loss. I think that's really valuable for people to hear. And I just appreciate your wisdom, brother. It's been great to have you on. We wanted to make this short, sweet, to the point. You crushed it, and we'll see you soon, man. Thank you.
All right. See you soon, Sam. Keep crushing it.
Boom. Did you love that episode? I know there were certain pieces of that episode that hit me really hard. Reminders that I needed to be reminded of. Thank you guys so much for supporting this show. I'm just going to ask you a very direct question. If this show has added value to your life in any way, I'm just going to ask that you please share this episode with a friend. Tell someone to get subscribed to the channel. Let's get the word out about real estate, right? Traditionally, real estate was only for the elite. Traditionally, real estate was only for the land owners, and only those people were allowed to vote. And it was the elite. But now we live in America. We live in a place where, yes, there are nuances to real estate, but we can all become real estate investors. I truly believe that with the right guidance, with the right coaching. I can't tell you how many people I talk to that are like, wait, I could buy a house for 3% down, like we talked about in this episode, or 5% down. Holy cow, like I could do that. And they just don't know. So let's get the word out there about real estate. Let's get the word out there about house hacking. Let's get the word out there about co-living and how we can do well by doing good and solve affordable housing, create passive income, and create wealth and generational wealth for our future families and for people around us. Okay. God bless you. Thank you for sharing this episode. Leave us a 5-star review if you loved it. If you didn't love it, then you can just, you don't have to leave any review. Actually, don't leave a review. But otherwise, I love you guys. We'll see you soon.